If you're looking to buy Mullen Automotive stock, then please keep watching this video because we're going to look at the company's recent news, how the market's treating the company, and what are the technicals telling us, and most importantly, what is the best trading approach. As the market is very volatile, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Mullen Automotive has been a popular stock amongst retail traders, mostly because the company has been publishing promising results regarding its batteries and also talked about a possible collaboration with a Fortune 500 client. The market is also wondering if the recent price action suggests that not only is the stock at a very low level at the moment, but it's also priced around its hard floor of $1. Of course, I understand that it went down as low as 52 cents in the past, but recently, despite repeated selling pressures, Mullen didn't abandon that level, despite receiving a lot of flack for not disclosing the identity of that Fortune 500 client. Overall, I think that Mullen still has to demonstrate to the market that it can deliver long-term values, but so far, from a purely technical aspect, the stock is priced at a very good price. Now, let's take a look at the technicals of Mullen. The trading volume of Mullen Automotive has recently been around 24 million shares versus a total volume of 60 million shares on the average. Over the previous 52 weeks, the price fluctuated between 52 cents and $15.90. The volume of shares traded tells us how many shares are being bought and sold at any given time, and if there's enough liquidity to support your trading strategy. If the float is very thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be a possibility for a trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume could be significantly higher than the one of the average volume. The market cap of Mullen is currently around $360 million versus the enterprise value of $112 million. Simply put, the market cap is the fair market value the company has based on current market conditions, the company's reputation, and macroeconomic factors, whereas the enterprise value is the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles. They're not things that you can see, feel, touch, or use just yet, but they're pledges for a better future, such as intellectual properties, brandings, and great managers, which can be valued very highly in good market conditions. What this could mean is that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below the book value, and that doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and only deflating to where it's supposed to be. As we compare the current price to the historical price fluctuations, the stock is 17% higher than the 1-month low, 40% higher than the 3-month low, and 103% higher than the 52-week low. On the options market, giving a hint about the market sentiment, the implied volatility is 191% versus a historical volatility of 108%. The put-call volume ratio is currently around 0.44, and for many stocks, they tend to have a higher put volume than what they truly deserve because many institutions would hedge their exposures by buying put options. The most recent volume of options traded is 29,000 contracts a day versus the 30-day average of 45,000. In terms of open interest, the most recent volume of open interest has been 361,000 contracts versus the 30-day average of 492,000 contracts. The option contracts are tools allowing traders to hedge their risk, increase their exposure with limited downside, or a revenue stream. They are derivative contracts based on the underlying security. They give traders the possibility to buy or sell the security at a predetermined strike price and helps limiting the potential downside. The put options allow selling at the strike price, usually for anticipated downturn, and the call options allow buying at the strike price, usually for anticipated bullish runs. In terms of shareholder structure, institutional shareholders own 1.6% of the outstanding shares. The biggest shareholders include Vanguard, Citadel, and Susquehanna. Usually, it's best to see some institutional participation when holding a stock long-term, because it offers a layer of stability and reliability in the medium to long term. This means that the market is confident that it'll deliver value for the long term, which is an important factor to consider. I personally believe that a minimum threshold should be around 25 to 30% of institutional ownership, although there could be many exceptions, as there are always a lot of great companies mostly held by retail traders. Now, let's also take a look at the short interest of the stock, which is the number of positions that will profit from falling stock price. The way it works is that short positions will borrow the shares from brokers, selling them in the market and buying them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there could be a potential for a short squeeze, whereby traders will buy the stock up, forcing these positions to be redeemed to avoid further losses, essentially acting as an additional buy. This is what people refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is 13.6% of the total float, and 46% of the transactions are coming out of the dark pools. I would recommend to buy Mullen at their current price or lower, but to always keep in mind that the stock should occupy a marginal portion of your portfolio, given the risk profile of the company and the outlook of the sector at the moment. I would recommend to commit between 1 to 3% of your portfolio's capital in Mullen and to split the allocation in batches of 20% or lower at a time to benefit from further retracements later. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.